Welcome to the Snowbirds Expat Radio Podcast. I'm your host, Gerry Scott. Today's show is really going to be geared towards the Canadian that has spent their entire working career in the United States. They have their Roth IRAs, their IRAs, and they're going to be moving back to Canada. And I cannot stress this enough that you really do have to plan well in advance when you come back to Canada. We're experiencing Americans that take these wonderful jobs up here in Canada, and I'll tell you, it's a lot of work that you have to go through because it's easy to go across the border for a couple of weeks and visit Canada or visit United States, but if you're trying to move to these countries, it's a lot of work. So a couple of weeks ago, we were having a podcast with one of our accountant partners. His name is Gordon Dale, and he's out of Michigan. And we started talking about the Roth conversions and how big and how popular this is. And in order for me to prepare for this, I went online and, like a lot of us, we just punch in Roth conversions or IRA conversions. And I came across today's guest, which is Craig Ware. And he's written books on this, and he's devoted his entire career on helping Americans convert and save taxes regarding estate planning. But when I called up Craig, we've had a few conversations since then. I said, Craig, this is a great strategy, but this is a must. No, this is a strong opinion, and it's not no such thing as one size fits all. But in this case, for Canadians moving back and forth, Craig and I were having this conversation, and we thought this would be a great opportunity to invite Craig to be part of our podcast and go over this. So, Craig, welcome to the Snowbirds Expat Radio Podcast, and tell us a little bit more about yourself.
Well, thanks, Gerry. I've been looking forward to being here. I really have enjoyed our conversations, and hope I can add some value to you and to the people that are listening into it. So, as you mentioned, I've kind of been in the industry focusing on Roth conversions. I started off kind of as the classic full-service financial advisor. We did everything and sold that practice years ago. But before I sold the practice, I had a client come to me that had actually listened to me in a talk radio show I used to do. And he was just very emphatic that I was missing the point from a tax standpoint, on converting his large 401k IRA over to a Roth. And we had kind of a little bit of a discussion about that led to me just kind of having an aha moment that all the things that I thought that I knew about tax and Roth conversion were actually false. They were just myths that were propagated by people in the media that really didn't know what they were talking about. They were just opinions and not really had done the math. So that just launched off into all kinds of different things. It started the first book that I think you read, Paying the Piper, and then the next book that was Roth Conversion Secrets. And as they say, the rest is history. It's been pretty cool. We've been able to help 700 or 800 people now over the last just 3 or 4 years of taking this to a national audience. And hopefully we'll be able to educate some of your listeners as well.
Well, I got to tell you, when I downloaded your book, it's available on Amazon, and it's called Roth Conversion Secrets. I haven't read the first one, which is called Paying the Piper, but that is a common word used up in Canada here, and we don't call it pay the piper. We call paying the pipers, because I know United States, some of the states have state tax, others don't. In Canada here, we have federal tax and provincial tax, and so there is a list of pipers in Canada. So I'll tell you,
they all have their hand out, right?
I'll tell you, they got and they're smart enough. They don't have their hands out, Craig. They have their buckets out.
Oh, wow.
I mean, you can hold more in a bucket than you can in a hand. So I'm kind of being sarcastic, but we do have very high tax rates in Canada here. And yes, it's a beautiful place to live. And as you and I get into this discussion about Canadians coming home and the importance of them converting looking at this strategy. So let's dive into it. Tell me more about, so the last book you talk a lot about the 5 biggest mistakes that these IRA millionaires are making. So let's go into those mistakes, and then we'll talk about how people can get a hold of you as well.
Okay, great. So let's probably start. You said the IRA millionaires, which is kind of a term that I call the people that we serve the most. But let's real quickly, let me give some parameters of why we talk about IRA millionaires and not just everybody. I think that's a fair place to start for somebody that's kind of listening in. The problem with large IRAs is that they grow, and over time, when you hit required minimum distribution age, they start throwing off these large taxable income streams that cause a lot of problems for people. When you have less than around a million, and that's a very loose number, normally the required distributions don't add up to a whole lot of money that cause an American citizen to have to pay more tax on Social Security, higher pension tax, all those kinds of things. But if you've got a couple $100,000 sitting in an IRA, the RMDs that are going to throw off from that are probably not going to cause such a huge problem. And in fact, I did a podcast that we talked about four conditions under which you probably don't need to worry about converting. But for your listeners that are either at the million or more mark, or they feel like they're going to get there before they're in their early 70s because of growth and other contributions, then the things that I'm about to share are very much well worth them looking into. So does that make sense of why the million is an important number?
Sure does.
Okay, cool. So, and feel free to interrupt because I've talked about this so much, I could just go on a rant forever. But one of the things, and our advisors get to talk to a lot of people, and we found some common mistakes that people make. And it's not just the do-it-yourselfer that likes to do their own homework and their own financial stuff. We see it happen with advisors. We see it with CPAs. We see tax attorneys. In fact, I've got several of them have come on board as clients of ours. But probably the single biggest myth that I'll say, mistake, is that people like to think that when you do conversions from an IRA to a Roth, that you only want to convert up to the top of your current federal tax bracket. So if you're in the 22% tax bracket, the common thought is, well, you probably don't want to convert any more than will take you above that 22% tax bracket. And what we've found by doing the math is that is a recipe for just paying the pipers a whole lot of money. The gold really happens. The benefit, the value of doing Roth conversions normally is not at your current tax bracket unless you have a more modest balance. Then you can get away with that. We've developed our own software where we're able to evaluate a variety of different tax brackets and strategies all at one time and look at them. And I've actually seen that a majority of the people who convert at the top of their current tax bracket will end up paying more tax over their lifetime than if they had not done any conversions at all. So think about that, let that sit in for just a minute. The common knowledge that's propagated in the normal financial media is that you only convert to the top of your tax bracket, and yet that subjects you to more tax than if you had not done any conversions at all. Think how crazy that is, right? So in order to get the real benefits from doing Roth conversions, you have to be willing to go to a higher bracket than you're currently in, probably convert over a much shorter time frame than you are currently comfortable with. And if you do that, the math, if you do all the math, not just the simple math, but if you do all the math, you end up being able to pocket, or let's say avoid, a lot more tax than if you just stuck with a common go to the top of your tax bracket. But CPAs like to talk about go to the top of the current tax bracket. Advisors like to talk about top of the tax bracket. And that's not because they're bad CPAs or bad advisors, Gerry. It's because it's not their main job. You know, their main job is to save you taxes. And so then to come in and to say this year you need to go to the 35% tax bracket, it just does not fit in most of their world. And because their main job is not to specialize in Roth conversion, they just are unaware is all that it is. It's not as though they're out to get you. It's just that they're unaware. And so that's what we've built a business on, is just being the specialist in that particular area. So that's the first one. The second one is, the second and the following are a whole lot simpler and a lot easier. But the second big mistake that's made, and I don't know how much marketing you do online, but the moment you put an ad out there on YouTube or Facebook, then everybody likes to pile on and give their own opinions about things, which sometimes it's really healthy, but other times it's really not. So one of the other big mistakes that people make is they say, well, gee, in the States, if you are signed up and enrolled in Medicare, you shouldn't do Roth conversions if doing the Roth conversion is going to create enough taxable income to throw you into one of the higher Medicare thresholds. So, Gerry, I'm sure you know what the Medicare, what I mean by that, but for the listeners, Medicare Part A and D, are income-based premiums. So your premium of what you pay for that portion of Medicare is based on what your income is. And they look back 2 years and they pick up whatever your income was off your tax bracket and they send you a bill. And if you have a lot of income, it's going to be a big bill. I mean, you could easily be paying $15,000 in Medicare premiums for a married couple because your income was too high. So a lot of people say, well, gosh, I'm not going to do Roth conversions because it'll throw me into another Medicare threshold bracket. Our average client saves about $2.9 million of income taxes. They avoid paying about $2.9 million of income taxes. And they'll save between $80,000 to $200,000 of Medicare premiums by doing the conversions. So what I'm trying to point out is two things there. Number one, that's a small part of the savings. It's a small part of the cost. But I've also just said that they actually they save Medicare premiums. And so by getting to higher tax brackets, what you do is you take all that higher taxable income, you throw it into a period of maybe 4 to 7 or 8 years on a Roth conversion. And then when you're through with that and the income goes away, well, Gerry, what happens to the Medicare premiums, right? They go right back down to the minimums. So if you have a large IRA and you don't do the conversions because you're going to go into a higher Medicare threshold this year, all you've really done is you've kind of sentenced yourself to higher Medicare premiums for the rest of your life. So that's the second mistake. All right. So how am I doing so far? We good?
I've got, as we go through this, I have a lot of questions that are, hopefully I don't forget my questions, but
Feel free to interrupt.
and I will write them down as we go along because I do have some thoughts. Because I'm
Yeah.
always, in this process, I'm always thinking as on the US side, the Canadian side, and then the cross-border side. So my brain is always being stretched. Some of the questions that you might not even be able to answer because you're a person that lives down in Texas. Is that
Yeah.
correct?
Well, I'm from Texas. We're living in Colorado. Yeah.
Okay, Colorado. Okay.
Yeah, but man, you feel free to interrupt anytime you got a thought that we need to talk about.
No, to keep this flowing, you keep going, and I
All
will remember. I will write down my core
right,
questions
cool.
here.
Good. You got it. So the third mistake is kind of like the second one, but it deals with Social Security. So as many people probably know, once you begin receiving Social Security retirement benefits here in the States, you don't have to pay any tax on that Social Security unless you have other income. And income above, I don't commit these numbers to memory, but somewhere $30,000 or $40,000 if you're married, you got to start paying 50% of your Social Security becomes taxable. And if you get up above another, I don't know, again, I don't remember what the thresholds are, but you can really quickly get to a point where 85% of your Social Security becomes taxable only because you had other income. Now, many people have pensions and other sources of taxable income that automatically are going to cause them to be in the 85% tax bracket. I mean, 85% of their Social Security taxed anyway. But there are a lot of people out there who stop doing their Roth conversions because they're afraid that they're going to have to pay tax on their Social Security not realizing that their required minimum distributions are probably going to force them there anyway. And so it kind of goes back to the basic principle. The principle that people utilized to be able to develop a nice nest egg was that they didn't look at today, they planned for tomorrow. They took action today that helped them tomorrow. Roth conversion strategy is really no different. But you have to reframe your brain. None of us like to spend money, and nobody likes to pay taxes. But I have said, especially here in the States, for US citizens that are thinking of going to Canada or whether they're just going to stay here, that you have to look long term. You have to prepare ahead of time so that the pipers don't get their hand in too many pockets. And if you'll plan accordingly, you can get a very strategic Roth conversion strategy put together where you may pay a little bit more tax for a few years, but then you've got yourself in a position where a big significant part of your entire financial portfolio is sitting tax-free in a Roth IRA. And for those people that maybe don't know a whole lot about a Roth, and you covered it on one of your recent podcasts I listened to really well, once you get money into that Roth, everything, all the gains that it produces and income that you take out of it for the rest of your life and your spouse's life is totally free of any taxes. So now you can see how the benefits of getting money over to a Roth begin to compound over time. And it doesn't take a lot of time for the Roth to really outshine another type of IRA or taxable retirement plan. So that's the third one. You don't want to stop making conversions because it may cost you more money in Social Security, because probably that tax bill is going to happen anyway. And if you don't do conversions, there's absolutely nothing you can do about it once it happens. So the fourth thing is really kind of looking down the road at what happens to your kids and your heirs, right? So the way the current law is in the US, when you die, you can leave your IRA to your spouse and they get the same benefits from over their lifetime. When the second person dies, then you leave it to your heirs. And recent legislation through the Secure Act changed it to where instead of being able to stretch that over their lifetime to take taxable income over their lifetime, now all that money has to get out of that IRA in 10 years. So now all of a sudden, if you got, let's say you got $1 million in an IRA today, and if you're like the typical IRA millionaire, they're not going to use much of that money over their lifetime. They may dip into it for a trip or something like that. Well, that million can become 2 million and can become 3 million before they die. Well, they leave that 3 million bucks to, let's say they got 2 kids. Each of the heirs is entitled to $1.5 million, and they have to take that $1.5 million within 10 years, and every penny of it is taxable. So if they leave it and it grows from 3 million to 3.1 million the next year, and then 3.5 million, and then 4 million, they leave it for 10 years, they got a huge tax bill. But let's just deal with that $3 million number just to use a number. If they're in the States and they leave the 3 million to the kids, Uncle Sam is going to get his portion of it based on what all their taxable income is. So if each kid takes, best case scenario, they take it all. And they take their entire half the year after mom and dad are both passed. $1.5 million, totally taxable, thrown into their other income. They're going to pay 35-40% in total tax. And if they're in New Jersey or California, it's going to be closer to 50% of it is going to be in tax. So 50% of each share of the $1.5 million means 50% of the total. So Uncle Sam on this side of the border gets 50% of it. Each of the kids end up with a net of 25%. So by not doing conversions, you leave the math to the IRS tables instead of to your own device of what do I want to do during my life to minimize that for the kids. And the more kids you have, the more disproportionate the share becomes. The government keeps more and the heirs get less as a percentage, only because the taxes got to get paid, right? And I would imagine in Canada, based on the little bit of understanding that you shared with me about how that works, the numbers are even worse and the outcome is even worse if they don't get this done before they get back over across the other side of the border. The last one is also kind of related, but there are a lot of our clients that have what we call charitable intent. So they support their church, they support a university, they support a 501c3 organization, and when they're doing Roth conversions, they don't take that into account because it's a fantastic strategic opportunity. As you and I both know, there's a type of an account called a donor advised fund where a client can take and put a significant amount of money into a donor advised fund, and they get a charitable deduction for it in the year that they do it. So let's say they got $1 million sitting in an IRA, and they know they're not going to use it over the rest of their life, and they know that they're going to give $50,000 a year away to a charity. Well, some people take the approach, well, I'm just going to wait until I get into my 70s and I'll use these special distribution rules called qualified charitable donations, and that's how I'll handle the required minimum distributions. The problem is on a $1 million IRA, the 50,000 to a charity isn't going to cover all the RMDs. They're still going to have taxable income. But if you have charitable intent, let's say they gave $250,000 all in one year and they put it into a donor advised fund. Now they have a checkbook, so to speak, that they can write against that donor advised fund. Anytime they want to make a donation, they get to choose who it goes to, what 501c3 gets it. They have total control, but they have given away those assets. But they get a tax deduction for $250,000. Well, think about what that means in the Roth conversion world. You can match that $250,000 with the $250,000 Roth conversion, and you effectively pay no tax on the $250,000 that you want to get over to a Roth. And so whether it's that or whether it's the other end of the spectrum saying, how much do I need to hold on to in the IRA because I am going to use these, we call them the QCDs. So not everything necessarily has to be converted, but there is a strategic level down to which you can convert, leave money in the IRA so that you can still take advantage of the tax benefits that go with it. So, and there's probably other mistakes that I could have written about, but these are really the biggies. These are the top five. A bonus one is that people that are still working in their last few years really need to evaluate whether they continue making 401k contributions or not, because they're just adding to the eventual problem. So we like to tell our clients in general, this is general advice, you'd want to get with Gerry and your financial advisor and, talk through how this really works for you. But we have people a lot of time lower their 401k contribution to only the amount that the company is going to match, and then take that extra cash flow and use it to pay taxes on doing conversions if they don't have cash sitting around someplace else. So that's the bonus. That's a freebie. It didn't cost anything extra. How's that?
Okay. Okay. So I've done a very good job of holding back my questions. So the first thing is that which president initiated this strategy, and how long ago did this become, people were aware of this conversion strategy?
I don't know the answer to that. Somebody told me 1988. The Roth came into law somewhere in the late 80s, and the conversion part followed right after that. So it's been around a long time. It's just not talked about much.
So, and then when the Secure Act changed the contributions so that an inherited IRA, you would have a 10-year window. Are you still able to use those inherited IRAs as a strategy so the kids would receive the inherited IRA? Does it still make sense with an inherited IRA to?
No, that's a great question. Whether you have an inherited IRA from your family or whether you leave it, Roth conversion is not available inside of an inherited IRA at all.
That's a good question.
You're just kind of stuck.
I've always said when I have a chance to speak with people like yourself or immigration lawyers or cross-border accountants, a lot of times I really don't know the answer. Mm-hmm. And but I'm a sponge after this podcast. I'm not saying I'm going to be an expert, but it sure helps my education and my knowledge to be able to realize who we should point these people towards, what professional, because I never want to come across as being an immigration lawyer or accountant or anything.
Sure.
The other question I have is The ideal age, and where do we see this happening?
So the sweet spot is between 59 and 73 or 4 years old. That's where the greatest amount of benefit is going to happen. At 59 and a half years old, any money that you convert from an IRA or a 401k into a Roth has a totally different 5-year rule that applies to it. If you convert after age 59 and a half, you can have immediate access to 100% of the amount that you convert. The 5-year rule that applies there has to do with the earnings from that money. So if you convert $200,000 a year for 5 years in a row, day 2 after the very first conversion, you have access to $200,000. Day 2 after the second conversion, you can get 400,000. Day 2 after the third conversion, you can get 600,000. Now, if something comes along in your life where day 2, year 3, you need $620,000 for something, 600 has no penalty, no tax. 20,000 you have to pay normal income tax on. So it's not like a big haircut if you have to get to it early.
Now, I guess the other way when I think through the strategy, if you're 59 and a half years of age, we know that's where you can get that 10% is reduced on the IRAs or the Roth. So if I'm going to work another 5 years between 59.5 and say 65.5, that's probably not a bad strategy because I have enough cash flow from my employment to continue to not have to worry about it.
Yes, but even if you didn't have enough cash flow, it still is worth it, even if you have to pay the taxes from within your IRA or your 401k, if you have access to it through your company plan. We have a lot of people tell us, well, gee, I'm not going to do conversions until I retire because my income is too high. And yet we run our evaluation and we can show them that they're leaving millions of dollars on the table by waiting, because that $2 million IRA 5 years from now is maybe 2.7 million. And now they got to pay more tax on a higher balance and maybe at higher rates. That makes sense?
Yeah, it does make sense. Now, the other thing is that just to let people know that, I mean, this was not a strategy that you just kind of learned. I mean, yes, you've been working on this for years, but you spent a lot of money on the software that you put together to make sure you cover off all the variables.
Yeah, for sure. That, Excel spreadsheets are great, but I realized very quickly in my journey on this that, they may work fine for evaluating a couple different things, but very few people are adept at A, the spreadsheet world, and B, understanding all the financial implications of all these things that dovetail into making really an optimal decision for people. And like you said, I mean, there's a lot of time that's gone into it. And just like anything, just like, your specialty of dealing with the snowbirds and folks going back and forth across the border, my guess is that you understand a lot more about the dynamics today than you did 10 years ago or however long ago when you first started discovering that you could help people with cross-border situations. And that's our advisors and what we do. Because we specialize in it, we see it a lot more and we have to think about it with a lot more intensity. And so software is great, but it's just a tool that really helps our advisors really do better diagnostics. We like to liken ourselves to the cardiologist in the medical field. This is just all we do every day, and so we've seen a lot different situations.
So when you and I first started talking about this, and I got to tell you, I believe the conversation between you and I is I asked, how many Canadians have you come across and you've done the Roth conversion? And I'll answer my question first. We had about 2.5 years ago, we had this doctor, and she started talking about, okay, I'm planning for the next 5 years. I'm going to do this IRA conversion, Roth conversion. And I'll be honest with you, I'm on the call, and it's like a deer staring into the headlights. I had no idea what she was talking about. And then, of course, when I asked you the question, have you ever had a Canadian come to you and say, listen, I know the tax rates are higher in Canada. This Roth conversion, This IRA conversion, Roth conversion makes all the sense in the world. Let's do it. Have you come across any Canadians?
Not one time, zero.
Now that is to me, um, I can't believe it because this strategy makes so much more sense for a
Yeah.
Canadian coming home. And once again, like you say, the minimum years that you would need to do this and make it work, make it work. What is the minimum years a person should be doing this over?
That's really unique and different for every person. I would say that on average, when we optimize a strategy for a client, on average, we're looking at a 4 to 7 year game plan. And that's not because of our our devices, it's because of the way the math works out to optimize it for them. But we have, probably on our little metaphorical bell curve, we've got 10% of the people that we actually do this over a 1 or 2 year period of time. Those tend to be people that make a lot of money and have large IRA balances. They tend to be better off to pull off the Band-Aid faster rather than slower. But after you connected with me, I got to thinking about the whole question you asked about the Canadian stuff. And it amazes me that we haven't had people in all the marketing we do around the nation. It amazes me that we haven't had people come to us with this problem yet. But you and I are going to have another podcast where you'll come and educate me and our listeners, and hopefully we'll be able to help some more people that are cross-border focused too.
Well, and here, excuse me, here's the opportunity when you do move from United States to Canada, and you've done this Roth conversion with Craig. When you move to Canada, it's very important that you file an election within the first year, the first year that you're going to be filing your tax returns with the CRA. There's an election you file to say, listen, these are contributions to my Roth, they're after tax. And we want to make sure that program in place that you've set up in the States is going to be treated the same as it would be in Canada. So it's very important that when they come across that they file the election, because if they don't, all this time and money and effort you've put into this Roth conversion will be taxable in Canada if you don't file this election. So we'll cover that on your podcast. But I'll tell you, we know we're going to open the floodgates for Canadians using Craig's services.
So
Because this
Gerry,
strategy makes.
Gerry, let me ask a question. So that Canadian or the American who's crossing border and going to live in Canada, do they need to have this completed before they get over to Canada to avoid the
No,
maximum amount of tax?
no, it's not a filing with the IRS. It's going to be a filing with what we call CRA,
Okay.
Canada Revenue Agency.
Okay.
Um, that's the first time I've ever had to say CRA and really understand what the abbreviation stands for. Um, but yeah, it's very important. And when you move to Canada, so let's say, for example, you move there in December, you have until the following April 30th when comes time for you to file your tax return, that you have to file this election. And the other thing you got to be careful with as well, too, when you do move your IRAs to a new institution, and I'll say we'll use like Pershing as a custodian, they will have a 5-year rule that they're going to withhold tax. And then you have to go through the process of filing the proper papers to get that money back. So there's all kinds of things that you have to be really, really careful with. It is always disclosed when you set up an account with the advisor that's using Pershing. I believe it's a Pershing rule because they don't want to be subject to any tax and liability. But the advisors have to do a very good job of disclosing that verified print on that application that you're scooting to the bottom to sign your name at.
Wow.
So you got to be very careful. Um, you know, and like I say, the more that you and I start talking about these Canadians moving home, this is really, there's nothing in Canada that you can do. And I do have another question that's coming to my mind as well, too. In Canada, we have what they call RSPs, registered retirement savings plans. And then at age 71, you have to convert it to a RIF, registered retirement income fund. And like an RMD, there's minimum amounts you're going to have to receive. And it basically, like an RMD, it would go up each and every year. you have to take that money out. That's the minimum. The maximum, obviously, you can take out as much. But we don't have any of these, none of these strategies are available for Canadians to convert this money to what we call your Roth IRA. We have something comparable called a tax-free savings account. And we don't have that rollover provision that allows people to do it. So the only thing people can do with large RSPs is they start looking at insurance contracts, maybe a type of a whole life or a universal life. Are you able to do the same thing in the United States? Buy a contract, some type of insurance contract that's going to take care of the tax? Has that been popular in the United States?
No, you cannot do that. You cannot put IRA money inside of a life insurance
No,
contract.
no. Let me add the question. Just
Well,
knowing what your tax liability on death is, and if you know that it's going to be $1 million tax bill, are you seeing people buy insurance to offset that
oh,
$1 million?
absolutely. Oh, yeah,
Okay,
absolutely. Yeah, we over here we call them second to die policies. When
okay, perfect.
yeah,
That's exactly the same as us.
yeah. The other thing too that just came to my mind that I'll mention is that there is some urgency about your listeners really finding a solution to this sooner rather than later. In the U.S., back in 2017, the then President Trump signed the law called the Tax Cut Job Act. And at that time, what happened is it lowered all the tax rates down pretty significantly to stimulate economic growth. Well, at the time that law was passed, it was already built into the law that it would sunset, it would go away at the end of 2025. So January 1 of 2026, all the tax rates in the US go back up. And the higher brackets go up less, but there's about anywhere from 10 to an 18% increase in the amount of tax that you're going to pay at the same tax bracket. So taking that into the Roth conversion world, if your game plan is not one that you should get it converted in 24 and 25, then anything that's left in that account is going to have higher tax in 26, 27, 28, and further. So we just really encourage people, get your plan early. You'll convert smaller dollars, hopefully, at a lower tax rate. Very seldom are they going to be able to get the conversion done in 24 and 25, again, unless they have really high income and really large balances. But we just really try to light a fire under people and say, look, this is really significant. Why would you subject the rest of your retirement account to an extra 10 or 18% tax to get it converted when you can do it now? So that's just a little bit of a sick'em, if you will, as we say down south.
Craig, as I was preparing for this podcast, I went onto a site looking at the combined the federal rate for Ontario, federal and provincial rate for Ontario, federal rate and provincial rate for the province of British Columbia. And I'll tell you, these numbers are intimidating. They're depressing. We can see that in some cases, they compare the federal rate in the United States to Canada, and it shows that Canada is actually comparable. But then when you throw in the provincial tax rates and the top rate in British Columbia, and I'll be careful how I say this number because it could be a little misleading. Ontario is 53.5%, and Canada in British Columbia, which I believe is still part of Canada last time I checked, 53.53%.
My goodness.
And then, of course, capital gains is taxed at 26%. Dividends are 39.34%. And non-eligible, which would be things like interest income, would be 47.74% in the province of Ontario. British Columbia, it's 48.89%. And I could be getting those numbers because I did the old cut and paste, and I probably cut off which province I was talking about. So we know that this is a must. Craig, how do people get a hold of you?
Probably the best way to start is just go to our website, craigweir.com, CraigWear.com. Maybe you can put it in the show notes. And on there are all kinds of free resources, podcasts. They can download both the books. I think one of them is free. The other one is $3.95. So instead of putting 20 bucks in Bezos' pocket, they can go to the website and get them at a big discount and get it delivered immediately through a full color PDF. And that's probably the best place to start. They can sign up for our email list. They can register for webinars that we do, listen to old podcasts. And I just, this whole Roth conversion subject is kind of like a slippery old creek bank. The closer you get to it and the more you investigate it, the more likely you are to just fall in and really enjoy the results.
The other thing that I will stress as well, I mean, one of the reasons that, for what you do, yes, you do charge a fee to do this, but at the same time, you've taken away all the advisors are going to use this strategy to sell you on it to manage the assets. So I do like I do enjoy your service and I enjoy your approach. You charge a fee to go through this process with clients, and then you can do it with your existing advisor. But at the same time, we got to be very careful that this is not, like I say, you've taken away all the conflict of being the advisor, of doing this just to get the assets. And I think I can't stress that enough. So I do love your approach.
Yeah, and the sweetener that we put into the deal, Jerry, which is very unusual. I appreciate you saying that. And by the way, our whole fee structure is on our website. People can go check that out. But the thing that's not on the website, I don't think, is that for clients that come to us that are under 75 years old, where we can actually get the biggest bang for them. We have a lot of clients well into their 70s that do this because of the charitable and their heirs. But under 75 years old, we have a written in our financial planning agreements, we have a paragraph written in that we actually will refund 100% of the fee they pay us if we can't demonstrate at least $500,000 of tax avoidance over their lifetime and for their kids. So we're trying to make this kind of a no-brainer that people can actually kind of start the process knowing that they really, if we accept them into our practice and into our program, they have nothing to lose and everything to gain.
Well, I have to tell you, the people that I enjoy the most on our podcast and the people that I enjoy the most in life are people that share the same values. And I know on the very first conversation we had, our values were in line, and that's what I've enjoyed about getting to know Craig. And on that note, Craig, thank you very much. I appreciate your time. And I can never end any show without saying, remember, the world is small. Be kind to all.
I love it. Thank you, Jerry. I appreciate you having me.
All the best.